Now, Amit Jeswani will be joining us in just a bit, CIO of Stallion Asset, to talk about his outlook for the equity markets as well as individual sectors. That's coming up in just a bit, but for the moment, let's connect with our technical guests to find out where they're placing their bets. Manas, I'm going to come to you first. We've spoken about your outlook on the markets, so take us through your top calls.
Right now. First is a sell on Equitas, where I think stock has been facing resistance near to 135, 137 for last, I think, 3-4 weeks time. And looking at the pattern today, because stock has broken its 20-day moving average, we have seen higher volume today. So I believe that this time it can even break. It can even break its 200-day moving average, and it can go down and test 122. To take a short call here, stop loss should be 134. And second is a buy call on Raji near to, I think at current levels you can buy Raji Exports, because I feel that the consolidation phase is over. And looking at the breakout today, I believe that even from current levels, you can see almost 35 to 40 rupees up move. So take a long position here in Raji Exports, and stop loss should be around 680.
Okay, there you have it. Some interesting recommendations there from Manas. Meantime, Kunal, what's looking interesting today on the charts?
So two buy calls, Avan, at this hour. One of them is a buy on granules. Now the stock is coming back, some sort of momentum, some sort of a short-term rally. Looking at the volumes, the way the charts are positioned on the daily time frame, I believe that there could be an upside of another 7 to 8 rupees from current levels. So given the targets earlier to 122, the stock has rallied in the last half an hour or so. I believe you could now revise the targets higher to 125 on granules and trail the stop loss to 113, which suggests that as a buy at current levels as well. And the second would be a buy on Torrent Power. Even that stock, I believe, is on the verge of a breakout. It's forming a triangular pattern on the daily charts. The breakout is closer to 264 levels, but I still believe that at current levels, the charts are positioned quite well. The risk reward also is pretty attractive. So Torrent Power is a buy in that regards. Targets of 272 at least, and stop loss at 255.
Okay, so those are some of the picks coming in from our technical experts this afternoon. Let's also now get in Amit Jeswani, CIO at Stallion Asset, and get his views on where things stand. Amit, a bit of an adjustment, as Kunal called it earlier today, when it comes to the index, but post a long weekend, post some key earnings and inching closer to the end of elections. What's your view? How do you see things shaping up over the near term, particularly given that globally, of course, we're seeing resilience? How are you expecting things to sort of move from here on?
Hi, good afternoon, and thank you so much for having me on your show. See, the life of a portfolio manager at a current stage is really difficult. You have an auto slowdown. You have real estate sales which are down broadly 30-40%. You've got AC's sales down 10-15%. So broadly, you have a urban consumption slowdown. Even if you look at the rural market, that's slowing down. It's probably in a crisis right now. And if you look at like capex recovery, there is absolutely no capex happening in steel, power. These are basically the larger capex cycle kind of plays. So it's not easy for portfolio managers to pay for buy high P multiple stocks without growth, but on expectations of growth. So that's become some kind of problem. See, there are things which are doing well, like the restaurants in Mumbai and bars in Mumbai are doing well. So there is a company in China, Hunchao, and that company became a $150 billion market cap company. It's an alcohol company. So basically, those are the kind of themes which should ideally do well over the longer term. Now, what the economy needs is at least 100 bips cut in interest rates. Shaktikant Das is the most dovish RBI governor that we have had in the last 15 years. So the economy needs a kickstart. The economy looks poor, but we in the stock market, we don't have to worry too much. There are two main rules of the game. Rule number one is that everyone makes money in a bull market. Rule number two is there is always a bull market in at least some sector. So our idea is to just buy the sectors which will lead the next bull market.
Okay, fantastic. Well, Amit, I'm going to come back and ask you on those sectors in a moment. But just before I do that, could potentially the spike that we're seeing in crude, could that throw a spanner in the works at this point?
I'm sorry, I couldn't hear that question well.
The spike that we are seeing in those crude prices, and given that crude is surging now ahead of its 5-month high, looks like we might see it sustain at those high levels now, perhaps. Could that possibly throw a spanner in the works?
See, the inflation is at 2%, it probably go to 3%, 4%, but your interest rates are at 6, 7%. Like a 10-year bond yields are at 7%. I don't see how this crude rally is a secular rally. Crude is now in a proper range between $45, WTI crude, between $45 and $70 broadly. So that's broadly going to be the range for the next few years. This is what I expect. So crude will not be such a large barrier. We have broken the back of inflation. So inflation is not there in the country. We need large rate cuts, and that's the only way to move the economy going forward. So I don't see crude as a large barrier. Of course, it will affect some aviation stocks and those stocks which are actually related to crude, but overall I don't see a very large impact.
Okay, so you're really focusing on the rate trajectory then. You've already talked about how we've had a slowdown so far. We are expecting another rate cut, obviously, in the next policy. That's what the market seems to be watching out for. And given, of course, that we're also in election season, so on and so forth, how much would you then place your bets on some of the rate sensitives? What would you be looking at?
See, we're always long financials, so that's one sector. Our largest weight for the last 5 years has been financials. Financials and consumers are two sectors where you can make money and retain money. So private financials, private banks, we don't buy government stocks, but general insurance companies, life insurance companies are now giving good opportunities. So these are, see, financials per se get better with size. Like you would not open your account in a new bank. You would open an account with an HDFC bank because it already has 5,000 branches, and these companies get better with size. So these companies, not a lot of people buy HDFC Bank and Kotak banks and all those of the world because everyone wants to buy the new cool thing. And 2018 taught a lot of lessons, that because 2017 was all about chore companies and low quality stocks, and that made a lot of money. 2017 was all about low quality. 2018 is back to quality. See, every 3 years you have like one mid-cap rally kind of year. Like it happened in 1999, it happened in year 2003, it happened in 2007, it happened in year 2010, it happened in year 2014 when Modi came back, and it happened in 2017. So probably the next large mid-cap run will happen in 2020 or 21. So probably in 2019 end, when I come to your channel, I'll tell you that this is the time to go out there and buy all these mid-cap kind of stocks. But till that time, we have to stay with the quality 25 to 40 stocks which are there in the market. So that's our broad idea, that we have a portfolio of consistent compounders and a portfolio of super stocks. So super stocks portfolios now, we are very new in the bull market. We just made a bottom 2 months back, but slowly we'll get an idea that which are the stocks that we have to be super bullish on and trade the next few years.
I will probe you on some of those names for sure, Amit. But hi, good afternoon. Reading your tweets as well. Consensus versus reality on the Nifty earnings growth. You put up an interesting chart for the last 8 years, and you've also said apna time kab aayega. So I'm going to ask you that question then. When is it going to be our time for earnings growth?
I think this year can be a good year. See, it doesn't matter. Our companies are growing at 30%, 25%. See, the private financials were always doing well. The thing was that every year you had some problem on another. Like 2015, you had your steel companies and your PSUs started reporting large provisions. So that's why your earnings went down. 2016, like FY17 became a washout because of demonetization. Then again, you had the steel companies and all those companies which were slowing up. So because of that, the Nifty growth doesn't look good. But you look at companies like the private financials have just done very well, fantastically well. And that is one space. Even consumers, Avan, that is one space that, consumers, they will always look expensive to you, but you will not have a large price corrections. They will stay there. They will still expensive for some time, and after 1 year, when they get to normalized level, people will buy it again. So consumer and financials are these are two secular trades. You can keep changing your horses. We changed our horses from NBFC to private financials, and you can keep doing that. But these are two sectors which you can make money. See, the small cap guys, Avan, they make money, but they don't retain it. They don't take the money home, and that's not worth it. Like it's a game that we all want to play. we all are greedy, we all want to get rich faster, but it's a very dangerous game. So you need to have like a portfolio kind of approach, and quality is doing well in India. Quality stocks are doing extremely well, and they are the stocks which are growing at 20-25%. So look at the other small caps. The earnings growth there is not there. So for me to buy a small cap, I need at least 30-40% growth. But that's not happening. It's not coming. It's not even there in the SME space, to be honest. So it's not easy.
Yeah. Okay, that's the outlook coming in. You're maintaining that very consistent stand when it comes to portfolio building. Stay with us, Amit, for the moment. Kunal, I want to talk about what you're doing with some of the OMCs. Can't ignore the trend that you're seeing. Of course, there's that whole, correlation with what's happening with crude, the currency, etc. BPCL is the 341. You've got IOC down nearly 4.5%. What's the outlook?
So yeah, I think these stocks should continue to drag a bit. It all depends on how the crude rally shapes up, because now I think if for maybe another $3 or $4 spike in crude, if it happens say in a short span of time, then the impact could be a far more severe for these stocks. And looking at the chart patterns as well, the last 2 weeks, 3 weeks, the stocks were going through a bit of a range. The volume volume sort of ebbed off. You saw a bit of fatigue into the rally, and when you see fatigue, at the last end of the stage, and then you see some, external factors like crude, which had started to, boil up. I think then the impact of a correction could be, far more severe. So I think it all depends on how the crude shapes up. But yeah, these chart patterns look a bit edgy. These stocks are now trying to break their 200 moving averages, which I've been highlighting since last, few weeks. That's a very critical, parameter to look at in this trend. For the market. So I think if these stocks manage to break those levels, those key support levels, and close below it, I think it could warrant another correction. Maybe another 5 to 7% correction could be possible into these names.
Okay, let's in fact get Mubina in to decode some of those factors at play right now, and really where crude is headed. What the sense is, what we're tracking. Mubina.
Well, crude certainly has been on the boil, $74 per barrel, highest level since November, though of course it's ebbed off a tad bit from those levels. And this time around, it's the steadfastness from the United States that is perturbing the street. The Iranian sanctions, the waiver that was granted to India and China will no longer be the case. They will have to stop purchasing oil from Iran, which is the fourth largest OPEC producer of oil, 2.75 million barrels per day. Remember, back in November, they had granted these waivers to India and China. And if Iranian oil purchases do dwindle down to zero, it could spell big trouble for EMs that do have a large proportion of their oil requirements imported from Iran. So this is something that one must watch out for. Crude prices are once again on the boil.
Oh, they sure are. In fact, let's hear it from the market experts as to what they're making of the latest surge in crude oil prices, as well as the effect on the Indian and the global markets.
So I think, hope it is near term and it further cools off. But then if it hovers around $80-85, we have seen India cannot take beyond $70 to $73. So obviously there will be impact at some level in terms of demand destruction coming into play. Already you are seeing some of the demand indicators being slow. So to that extent, oil at this level further going up is not at all good for the economy like India. So difficult to predict what will happen, but then generally the tone will set, the tone which will be set will be more negative than positive.
I don't know whether they'll dwindle down to zero, but he's certainly, with John Bolton's assistance and a very sturdy hand, I think he's going to cause major economic impacts for Iran, and how many barrels they're allowed to export and where they're allowed to export across the world is going to be a very, very telling tale. And I think that that's going to underpin price, and that's been very evident in the last matter of 24 hours. And I think there's further upside over the next week. Anyone at Christmas would have said, that, there's no way that you'll hit those sort of numbers by mid-April or Easter, and it has happened. And I think there's even further upside for Brent. Brent's got the capacity to take an 8-0 number out, I'm fairly sure of it, sometime in May, if not sooner.
Emerging market economies, which are actually the biggest contributors of oil demand growth as well, are going to suffer. So up to $70 per Brent, I think, is still digestible, but beyond that, it starts getting difficult. Watch out for in the coming days and weeks is not just how high the crude prices go, but what sort of pressure starts to come down on OPEC from Trump and from other major consuming countries like China and India, which will be obviously be besieging the Saudis and the OPEC members to put more crude into the market, because not only are they cutting back, but they're cutting back much more than they had pledged. So I think we'll have to watch out for these things as well.
Okay, so that's the situation with crude, and we've been tracking that. Amit, what did you make of the Reliance earnings? Let's get your view there as well. A little bit of a correction coming in on the stock today, and we've been looking closely at some of the commentary coming in and the push on new businesses and so forth. But we'd love to get your view.
I might have vested interest in Reliance. So that is point number one. Please, all disclosures attached. We have positions in our PMS, our advisory, everywhere. Reliance is one of a kind of a company. So it gets free cash flows from the refinery and the petrochemical business, and it invests all that in geo expansion. So I am a big bull on Reliance, and I believe this is the leader of the next bull market. So this company will keep growing and surprising a lot of people for the next 3, 4, 5 years on the upside. So it's a easy, according to me, I might be wrong, it's an easy 25-30% CAGR plus trade for the next 3, 4, 5 years. This guy creates monopolies. Every time he creates monopolies, and this time is going to be no different. If you look at the retail division as well, the way he's scaling up retail division today, he's become the largest grocery retail, like this year, he became the largest grocery retail company. He became the largest digital, electronic selling company with 40,000 crores of sales. So the way these guys scale up in India, the thing is that not many entrepreneurs know how to scale up or don't scale up so well. But Reliance is a superstar. You just keep it. Every quarter you'll have analysts giving 100 rupee up or 100 rupee down in targets. That will keep happening, but for us it doesn't matter. This is a guy who knows how to scale up. Geo is a class thing, and I'm super bullish, on this. This is a guy who knows how to scale up. This is a guy who knows how to create monopolies. And I don't see how anyone can compete against him in any business lines, refinery, petrochemical, geo or retail for the next 3, 4, 5 years. So, and there'll be a demerger. So now the story for the short term is all about deleveraging, how quickly he can deleverage his debt of 2.5 lakh crores. But overall, I am a super bull on Reliance Industries. But please, I can be wrong. I can change my positions, and yes, but I'm very bullish on it.
Okay, that point is definitely taken into notice, but you're saying that, eyes closed, this one is a keeper in the portfolio. What about Jet Airways? The saga is just continuing and unfolding and only getting worse by the day, it seems. Latest being that it's facing the risk of landing in NCLT. Look at the stock movement. Would you say don't touch this with a barge pole, or maybe there is, silver lining?
See, if you want to give money just away, just give it to me. Why do you want to invest in Jet Airways that way? So, at least you'll have a happy face in me. So, but overall, see, Jet Airways had happy customers. I was a happy customer. Everyone was a happy customer. It had happy employees. Okay, but happy customers and happy employees without good economics do not make sense. So that is one of the biggest learnings from the Jet saga. See, aviation, every 3-4 years, a few airlines will go bankrupt. That's how the game is played. The one who's the most efficient and the low cost guy, he will keep gaining market share. But these are punts. You can trade them for 1 year, 2 years, buy them, and everything's bad. Like you can buy Indigo and all those kind of stocks, but that too for a punt. So we don't have any aviation this thing, but it's sad, that Jet Airways went down. But NCLT, even if they go, what will they get? Because this company has no assets. So I don't know, probably some jet miles is, I don't know why they would go to NCLT. The only way out here is take a large haircut on your debt. Like 8,000-9,000 crores of debt, there'll have to be a 70% haircut, and that's the only way Jet can be revived. But I don't see a chance. This is not SpiceJet. SpiceJet had 1,100 crores of debt. This guy has 9,000 crores of debt. Why would I buy jet rather than starting my own airline? I just need 5 airplanes and I can start my own airline. So why do I buy jet? And anyways, the pilots will shift from jet to my airline. So I don't see a reason. I still don't understand why the stock trades at these levels right now.
What are you doing with the other names then?
Sorry, Abha.
What are you doing with the other names in aviation?
I'm not buying anything in aviation. We missed that trade out actually. We were just kind of stupid and lazy, I think. But we missed that trade out. We knew this was going to happen, but we didn't make money here.
Okay, what about IT? Let's look at that. Amit, we haven't caught up with you post the earnings, and given that that's the only pocket in the market seeing a little bit of strength today, how are you looking at IT currently? Perhaps a safer bet at this point, but even from a growth perspective, what's your view?
See, I'll tell you one thing. Like in the US market, so we study a lot of markets globally. I'm so sorry, I'm going a little off topic, but this is important research that we did. See, in the US market, if you're Apple, you make $70 billion of cash flow every year. Now, you can reinvest that cash flow at 2.5% bond deals. That's the bond deal out there. So if you keep buying back at 12-13 P multiple, like $70 billion of profit, and you keep buying back at 12-13 P multiple, basically you're getting your money reinvested at 8%. So buybacks make a lot of sense in the US market, because if Apple keeps buying back at 12 P multiple, they are basically making 8-9% for their shareholders every year, plus 4-5% earnings growth. So basically you get 13-14% in a year CAGR returns basically for Apples. But in Indian IT companies, our reinvestment rate is 8%. That's the 10-year bond deal basically. So if these companies buy at 15 P multiple, it makes no sense, because your reinvestment risk return is about 7.5%. I'm so sorry, it's a little mathematical, but logically buyback at 15-17 P multiple makes no sense for Indian companies. Overall, I like a company called LTTS. They are market leaders in engineering R&D. We might have vested interest here, but that is one stock where I expect 20% plus dollar growth. TCS is doing extremely well. Other IT stocks we don't track so closely, but because they're not like fast growing companies. But buybacks can create a lot of wealth if the stock is cheap, if it stays at lower multiple.
Okay, L&T Tech is what you like. Now, Amit, a question that we don't need so much theory on. I want your outlook on consumption. You've already spoken about this. Nielsen has said that FMCG has kickstarted 2019 with double-digit growth. Small players are showing a slowdown, impact in rural. We have seen the growth soften in the recent quarters. What are you picking out from the FMCG basket, given that you're bullish on consumption?
We are very bullish on consumption, but FMCG is a very small part of it. But we're more bullish on like FMEG. So that is one hint that I've given you. Like companies like Havells will do well. So those are companies which will do. See, they are expensive right now, so they can fall 10-20%. But consumption, I don't see how a slowdown can come. You should buy the MNCs out there. The Indian companies are okay, they're good as well. But the MNCs is where you should look and keep your focus on. The MNC consumer companies. So the profit pools are very small in India. Like HUL's profit is $1 billion. It's less than $1 billion. These companies will not top out here at $1 billion. These companies have a long way to go. So I'm like, these consumer stocks will keep compounding your capital, and they will beat your Nifty for a long time, even if you buy at 2 times Nifty P multiple. So these companies have extreme high ROEs of 100%. A Nifty cannot beat consumer companies if you have a 10-20 year horizon.
Okay, so any other names that you would like to share then?
I think Havells is a good bet. It's one of our core stock
Said that already.
Havells is, I've said Reliance is good. Havells is good. Godrej Properties, if you can get it cheap, I think this is a $2.5 billion market cap company. 90% market is not there. I don't see how in the next 5, 10, 15 years this company will not be a lot higher from here. So look at market leaders in their niche when competition is struggling. So those companies are unbeatable typically, but I might have vested interest again and I might be wrong as well, but I'm super bullish on like Godrej Properties, Havells. We have it from cheaper levels, but I'm still pretty bullish on these kind of themes.
All right, and the optimism perhaps says it all with respect to your outlook on sectors as well as the markets. Amit, great chatting with you. Many thanks for joining in with your outlook.